Hi, this is the Business Guy. The Foreign Account Tax Compliance Act, or Fatca, is a 2010 United States federal law requiring all non-U.S. foreign financial institutions, FFIs, to search their records for customers with indicia or indications of a connection to the U.S., including indications in records of birth or prior residency in the U.S. or the like, and to report the assets and identities of such persons to the U.S. Department of Treasury. Fatca also requires such person to report their non-U.S. financial assets annually to the Internal Revenue Service, IRS, on Form 8938, which is in addition to the older and further redundant requirement to report them annually to the FinCEN, Financial Crimes Enforcement Network, on Form 114, also known as FBAR. Like U.S. income tax law, Fatca applies to U.S. residents and also to U.S. citizens and green card holders residing in other countries. By the way, if you appreciate this straightforward information, please click the like button below so YouTube promotes this video. Thanks so much. And if you haven't already, please click the subscribe button below so that when more videos come out like this one or laws change, you'll be up to date right away. Now, we'll talk more about Fatca in a bit, but I think it's very appropriate here if I share my personal experience. Our company helps people set up offshore companies and bank accounts. This is one of the things we do, so I love it when an American company calls us and wants to expand overseas. After all, Japan set up what are offshore companies to them in the U.S. and are selling Toyotas and Nissans and Hondas all over America. So I love it when U.S. companies call us and want to expand overseas. But frankly, I don't want tax evaders calling us trying to break the law by not paying their taxes. I mean, I've been in this business for 31 years as of this video, and I haven't been around so long by helping people break the law. I mean, tax evasion is a crime. Knowingly helping people commit a crime is a crime. I sleep like a baby at night, and I want to continue to do so without having to look over my shoulder all the time. What's the best way to not get caught for doing something wrong? It's simple. Don't do something wrong. So that's why in my company, people know they won't be working here any longer if they do business with anybody who tells them they don't want to pay their taxes. And I say that to everybody who works here over and over again. I keep a written record of it. And everybody here knows I mean business. Don't screw with the U.S. government, the IRS. I mean, my father worked for the U.S. government during nearly his entire career. I mean, that paycheck that came in the mail for my dad every couple of weeks or so, I think had a picture of the Statue of Liberty on it. So that's how we put food on the table. My grandfather was a proud U.S. Marine. My own son was a U.S. Marine for 5 years. If some rogue government tries to hurl bombs at us and try to take us over and wants to try to force us to speak Russian or Korean or Chinese or Persian, the language in Iran, well, they're going to see fire rain down on them like they've never seen before. The tyrants in other countries don't want to mess with us. Why? Because we have satellites and bombs and missiles and ships and airplanes such that they will cease to exist. Don't think they'll come over here? Read your history books. See what happens to countries with weak defenses. So if you want to enjoy the benefits of freedom and living in the richest country in the world, you and I must pay our fair share. It's the goose that lays the golden egg. Think the government spends too much, it eats too much, wastes money? I agree. Well, a lot of us spend too much, eat too much. If you have a little weight to use, just say the government and I eat too much. Now back to Fatca. Fatca was really a godsend to us because it makes tax evasion for U.S. people nearly impossible. And nobody in his or her right mind who really knows how Fatca works could accuse us of trying to help people do so. Fatca applies to all subjects identified as U.S. persons. All U.S. citizens are U.S. by default, but a non-U.S. citizen can be eligible as a U.S. person for tax purposes. For example, green card holders and corporations under certain criterion, inhabitants of unincorporated U.S. territories, American Samoa, the Commonwealth of the Northern Mariana Islands, Guam, Puerto Rico, the U.S. Virgin Islands, are conciliated with a resident-based taxation. However, financial institutions are notified that U.S. taxpayer identification number information is mandatory for all reportable accounts with Fatca reporting obligations. Even residents of those territories do not pay taxes to the U.S. mainland. Likewise, Fatca does not apply to banks of Puerto Rico since they are classified as territory financial institutions. Nonetheless, customers in Puerto Rico must complete Form W-8-BIN and W-8-BIN-E as part of the account opening process, and reporting is almost the same as any other U.S. bank. However, Puerto Rico's Act 273 is that Fatca, Common Reporting Standards, CRS, and intergovernmental agreements, IGAs, signed between the United States and a foreign country do not apply to international financial entities in Puerto Rico. Fatca was the revenue-raising portion of the 2010 Domestic Jobs Stimulus Bill, the Hiring Incentives to Restore Employment, or HIRE Act, and it was enacted as Subtitle A, Sections 501 through 541 of Title V of that law. Now, according to the IRS, foreign financial institutions that enter into an agreement with the IRS to report on the account holders may be required to withhold 30% of certain payments to foreign payees if such payees do not comply with Fatca. The U.S. has yet to comply with Fatca itself because as of 2017, it has not yet provided the promised reciprocity to its partner countries, and it has failed to sign up to the Common Reporting Standards, or CRS. All European Union countries, China, India, Hong Kong, Russia, and 109 countries altogether have agreed to become signatories, but not the U.S. Now, the United States, in many cases, will reciprocate by sharing banking data with countries for which their citizens hold U.S. accounts, but not automatically, as is required by the U.S. in Fatca. Fatca has also been criticized for its impact on Americans living overseas and implicated in record-breaking numbers of U.S. citizenship renunciations throughout the 2010s and 2020s. Bills to repeal Fatca have been introduced in the U.S. Senate and House of Representatives. Background. Fatca was reportedly enacted for the purpose of detecting the non-U.S. financial accounts of U.S. resident taxpayers rather than to identify non-resident U.S. citizens and enforce collections. Although there might be thousands of resident U.S. citizens with non-U.S. assets, such as investors, dual citizens, or legal immigrants, Fatca also applies to the estimated 5.7 to 9 million U.S. citizens residing outside of the United States and those persons believed to be U.S. persons for tax purposes. Fatca also affects non-U.S. person family members and business partners who share accounts with U.S. persons who have U.S. person signatories of accounts. This feature allows the reporting of the assets of non-U.S. corporations, volunteer organizations, and any other non-U.S. entity where a U.S. person can be identified. Fatca is used to locate U.S. citizens residing in the U.S. or not, U.S. persons for tax purposes that is, and to collect and store information including total asset value and Social Security number. The law is used to detect assets rather than income. The law does not include a provision imposing any tax. In the law, financial institutions would report the information they gather to the U.S. Internal Revenue Service as implemented by the intergovernmental agreements, IGAs, discussed below. With many countries, each financial institution will send the U.S. person's data to the local government first. For example, according to Ukraine's IGA, the U.S. person data will be sent to the U.S. via the Ukrainian government. Alternatively, in non-IGA countries such as Russia, only the Russian bank will store the U.S. person data and will send it directly to the IRS. Fatca is used by government personnel to detect indicia of U.S. persons and their assets to enable cross-checking where assets have been self-reported by individuals to the IRS or to the Financial Crimes Enforcement Network, or FinCEN. U.S. persons, regardless of residence, location, and regardless of dual citizenship, are required to self-report their non-U.S. assets to FinCEN on an annual basis. According to qualification criteria, individuals are also required to report this information on IRS Information Reporting Form 8938. Fatca will allow detection of persons who have not self-reported, enabling collection of large penalties. Fatca allows government personnel to locate U.S. persons not living in the United States so as to assess U.S. tax or penalties. Under Fatca, non-U.S. or foreign financial institutions are required to report assets and identify information related to suspected U.S. persons using their financial institutions. Under U.S. law, U.S. persons, regardless of country of residence, are generally required to report and pay U.S. federal income taxes on all income from all sources. The U.S. and Eritrea are the only two countries worldwide which tax non-resident citizens. The law requires U.S. citizens living abroad to pay U.S. taxes on foreign income if the foreign tax should be less than the U.S. tax, called taxing up, independently within each category of earned income and passive income. For this reason, the increased reporting requirements of Fatca have extensive implications for U.S. people living abroad. Taxpayer identification numbers and source withholding are also now used to enforce asset reporting requirements upon non-resident U.S. citizens. For example, mandatory withholding can be required via Fatca when a U.S. payer cannot confirm the non-U.S. status of a foreign payee. The IRS previously instituted a qualified intermediary program under 26 U.S.C. Section 1441, which required participating foreign financial institutions to maintain records of the U.S. or foreign status of their account holders and to report income and withhold taxes. One report included a statement that participation in the QI program was too low to have a substantive impact as an enforcement measure and was prone to abuse. An illustration of the weakness in the QI program was that UBS, a Swiss bank, had registered as a QI with the IRS in 2001 and was later forced to settle with the UBS tax evasion controversy with the U.S. government for $780 million in 2009 over claims that it fraudulently concealed information on its U.S. person account holders. Non-resident U.S. citizens required self-reporting of their local assets was found to be relatively ineffective. The Hiring Incentives to Restore Employment Act, of which Fatca is a part, it narrowly passed in the House with no Republican members voting yes and passed the Senate with only one Democrat member voting no. President Obama signed the bill into law, and Senator Carl Levin has stated that the U.S. Treasury loses as much as $100 billion annually to offshore non-tax compliance without stating a source of the data. On March 4, 2009, the IRS Commissioner Douglas Shulman testified before the subcommittee that there is no credible estimate of lost tax revenue from offshore tax abuse. In his book, The Hidden Wealth of Nations, economist Gabriel Zucman estimates that U.S. persons hold $1.2 trillion in financial wealth offshore. According to Zuckman's analysis, this sheltering of assets results in $36 billion in lost tax revenue annually in the United States. Supplementing the reporting regimes already in place was stated by Senator Max Baucus to be a means of acquiring more financial data and rising government revenue. After committee deliberation, Senator Max Baucus and Senator Charles Rangel introduced a Foreign Account Tax Compliance Act of 2009 to Congress on October 27, 2009. It was later added to an appropriations bill as an amendment sponsored by Senator Harry Reid, which also renamed the bill the Hire Act. The bill was signed into law by President Obama on March 18, 2010. So in summary, Fatca requires foreign banks to report the financial holdings of U.S. people. Please click like, subscribe, and share this video. See you next time. This is The Business Guy.